Greetings to you all, ladies and gentlemen. Welcome to Accounting 1. We begin by discussion 1, which is an overview of accounting. We look at the definition of accounting. Basically, accounting means three things. It is the systematic recording of transactions in the books of accounts. That's number one. Number two, it is the preparation of accounting or of financial reports from the systematically recorded business transactions. And the third aspect is it is the analysis and interpretation of financial or accounting reports. Now, having looked at those three components, let's take a closer look at the definition of accounting. Accounting has been defined as the systematic recording of financial transactions in the business books of accounts, the formulation of financial reports from the transaction, and the analysis and interpretation of the financial reports into useful information that may be used by the management in their decision-making processes. Now, having looked at that, I want us to look at the key phrases that we find in that definition, the important terms in the definition of accounting. The first one is the systematic recording. What do we mean? Systematic recording simply means the process of recording financial transactions. It follows set procedures, principles, rules, and concepts. And we also need to look at financial transaction. When you look at the word transaction, it's a compound word, which means action that is taken across two people or institutions. So financial transaction simply involves the exchange of goods or money between two parties. This may involve selling, one paying money and one giving the goods. Then we've got financial reports. This refers to the income statements and the balance sheets, you name it, as well as the cash flow statements. What do we mean by analyzing and interpreting? Analysis and interpretation of financial records and statements is giving a critical examination of the sum totality of the financial recording process. Now, I want us to look at the branches of accounting. Accounting may be divided into three branches. The first one being financial accounting. Under this branch, that's where we find the bookkeeping, the daily recording of the financial transactions. Then the end part of this financial accounting process involves the preparation of accounts as well as preparation of reports that may be needed by the outside world. Then the second branch of accounting is what we call management accounting. Management accounting is basically internally focused. What do we mean? By being internally focused, we simply mean it is a branch of accounting that focuses on trying to provide information to be used by the people in the organization, that is the management. Then the third branch of accounting, this one, I want you to have some question marks on that because we need to clarify it further. That is auditing. Auditing simply focuses on the checking and verification of the accounting procedures, processes, and compliance with the state rules, business rules, international accounting standards, you name it. But as of late, you would find that auditing now stands as an independent field of study. So these are the three branches of accounting. Now, I want us to quickly go to the second part of our discussion, which I have named the discussion 2, where we'll be focusing on accounting concepts. We have already said that accounting is a field of study that is regulated by a number of principles, rules, procedures, you name it. Now, let's look at the common accounting concepts that you will come across during the study of your accounting. The first one is the business entity concept. Now, what do we mean by the business entity concept? We are simply saying when we are dealing with accounting, we are looking at the business setup as a person itself. We normally call it businesses are legal personas. which means they are pseudo personas or they are half people. In that, they can also have their own rights to own assets, rights to be sued, and rights to sue. Then we have got the second concept that I want us to look at, which is the going concern concept. A business is formed to stay forever. So, as we will be recording our transactions for a business, we have got at the back of our mind the assumption that the business will be in existence forever. We don't form businesses with the hope or with the intention of closing it down the following morning or the following year. The third concept that we will look at is the matching concept. The matching concept, it's simply a concept that tries to match the revenues generated by a business to the expenses that were incurred in the process of earning those revenues. So what we mean here is, even if payment has been made or not made, the payment that has not been made, we will need to trace into which month that expense belongs. And we will record that expense as belonging to that particular month, even if we have not yet paid. The fourth concept that we'll look at is the prudence concept. Right, what does this concept say? It says, in the event of uncertainties in the recording of our business transactions, we'll try to be as conservative as possible. What do we mean? We mean we must always try to take the worst case. Let's say you are not sure of your expenses, and your expenses are most likely, perhaps they are estimated at 50,000 or 60,000. The prudence concept says we must take the worst case. Instead of taking your expenses or recording your expenses as 50,000, it's advisable that you record as 60,000, which is the worst scenario. Now, we go to concept number 5, the consistency concept. The consistency concept simply says when we are recording our financial transactions, we must be consistent in as far as the principles that we use are concerned. For example, if we are using the historical cost, which is the basic concept underlining this field of study, you must make sure that in all recordings you adhere to the historical cost. If you are calculating depreciation and you use the straight line method of depreciation, it means in the succeeding years you must always stick to the straight line method. You cannot say this year you use the straight line method, next year you use the diminishing balance method. We must be consistent. Now, I will take you to discussion 3, the accounting cycle. What do we mean by accounting cycle? The accounting cycle is a process that has got inputs, a process that has got outputs. Inputs are those financial documents that we refer to when we start the accounting process. If you go into ShopRite to make a purchase, you are given a receipt. That receipt forms what I may say the beginning of the accounting process because it provides us with the source documents. Accounting, as you find out, it's all about basing our arguments on the records that are available. Now, let's look at the outputs. At the end of the accounting process, we will need to come up with the summaries of the recordings that we would have done. And these will come in the form of the profit and loss account or income statement, the balance sheet, which we now prefer to call the statement of financial position. Now, the accounting process involves a series of steps, that is analyzing the information from the source documents and coming with a decision as to which account we record them. Then the next stage, recording those transactions in the journals. A journal, it's a term derived from the French, it's a French term which means journal. Journal from day, which means it's a daily, like our diaries. We diarize everything that happens on a daily basis. So the second stage is we record the transactions in the journal. And periodically, we'll now go and collect the information from the journals and post them to the ledger. A ledger, it's a ledger book that has got a series or a number of accounts. This is where we do the sorting of the type of expenses that we would have incurred. And now at the end of the day, these expenses or accounts will be balanced off in order to form the reports, the financial statements. As diagrammatically represented there, the first one indicated by number 1, transaction source documents, where I said we'll be analyzing the documents, the receipts, the invoices that we get following a transaction. Then we journalize them in the journal book. Having done that, we now critically look at them and say this one belongs to that particular account in the ledger. Then we post them to the appropriate ledger account. At the end of the accounting cycle, which may be a week, it may be a month, it may be a year, right? We will need now to go back to the balance sheet and add up all the entries, total them, and balance them off. Then we will extract all the balances in the ledger on each account. Then we extract them as is, and we form a list of the balances which we will call the trial balance. From the trial balance, we will now post these, or we use these balances in the trial balance to prepare our financial statements. Well, I want now to take you to discussion 4, the accounting equation. The accounting equation is the fulcrum or the backbone of the accounting field. And the accounting equation is assets are equal to capital plus liabilities. And what does this tell us? It simply tells us that the assets that you find on the left side of the equation were either acquired or purchased using financial resources introduced into the business or injected into the business by the owners of the business, or those assets were acquired them through funds that we borrowed, or we acquired the assets by buying them through credit terms. Now, when we're looking at assets, we need to be clear on what we mean. Assets are basically the tangibles or the physical assets, the physical goods or the physical tools or the physical instruments that we use in the business. Examples are buildings, furniture, vehicles, you name it. Then when you go to the capital, capital is divisible into 2. We have got paid in capital, which is capital that was injected into the business by the owners of the business the time they started the business or during the course of the business. Then we have got the second part of capital, which is retained earnings. When a company posts profits, normally these profits will have to be distributed to the owners, or alternatively, they will be retained in the business. That is, they are kept in the business for the further expansion of the business. Then we have got the other aspect, the liabilities part. Liabilities are the debts, the monies that do not belong to the business. These are financial obligations that we need to meet in the future. We need to pay in the near future. Now, asset accounts, like I have said, include prepaid accounts. Sometimes you pay for your insurance 2 months in advance. It means you have not used that money. You have not yet exhausted that money that you have paid in your insurance. It may include accounts receivables. These are the people who owe the business money. It's an asset because when we get that money from those people, we use it to buy the other assets. We have got cash. Cash itself is an asset because with it, we can transform it into physical tangible assets. We can buy land. Land is also an asset. Notes receivables are also an asset, where the organization has lent money to its members of staff, and this money will have to be returned back to the business at some point. Supplies, we talk of stationery. If they are in our storeroom, they are not yet an expense, so we need to count them as our assets. So those are some examples of assets. Then liabilities, accounts payable. Those are the goods that we have bought from the suppliers and we have not paid for them. At some point in future, we need to honor our debts by paying. Accrued liabilities, we might be owing the receiver of revenue some taxes, if we have not paid and we have been billed, then those are liabilities. At some point, we have to pay. If the business has posted a profit and has declared a dividend, it must pay. But until it has paid, those remain dividends payable. They are liabilities. Sometimes we can have, for example, in a school, some students can pay their fees in advance. They have not yet received the tuition they deserve. They have paid that money for. So we have not earned that revenue even though we have recorded it in our books. Then we have got equity accounts. Those are what we briefly looked earlier on, the retained earnings, the paid in, the stock dividends, you name it. Those are our equity accounts. Now, the accounting equation, when you look at equity, equity can be further expanded into common stock, which is a plus to the owners of the business because it's their worth. Dividends, it's money that we have to go out. So from what we have in the business that is owned by the owners, we will have to subtract the money that shall be paid out. But when we look at the other aspect, the revenues, it's money coming into the business. So it's a plus, it's a cash inflow into the business. And expenses are a negative because they represent a cash outflow. Now, I want us to look at discussion 5, principles of double entry. What do we mean by double entry system? Well, this is a system or a principle that is adhered to in accounting, which simply say for every transaction that you record, you must record it twice. One is recorded on the debit side, one is recorded on the credit side. Since each transaction is recorded twice, then it simply means the total on either side of our account should always balance. Now, so when we look again at our equation, you look, we've got assets on the left side and liabilities and owner's equity, that is retained earnings and paid in capital on the right side. This, we can look at them as the two sides of our double entry system, whereas the left side will represent the debt side and the right side of this accounting equation is our credit side. So as you will find, assets are on the left, which is the debt side, and liabilities and owner's equity are on the right, which is the credit side. Now, I want us to have a clear understanding of what we mean by an account. An account is a record of increases or decreases in a specific asset or in a specific liability or in our equity. Then, the ledger is a collection of these accounts. Now, a business may have an account for salaries where everything to do with employment costs are recorded. It may have water, electricity, where everything to do with electricity and water is recorded. Those are what we mean our accounts. Now, in accounting, in our study of accounting, we normally use what we call a T account. A T account is a representative of the ledger accounts. A ledger account is well detailed. It has got a column for debt, a column for details, a column for the folio, a column for the amount, you name it. But in our study in the classroom, we normally use what we call a T account, which has got the left side, the debit side, and the right side, the credit side. So transactions are either recorded on the debit side or on the credit side. Now, I want us to have a look at the rules that we normally follow when we are using the double entry system, the rules of debit and credit. Well, if you look below there, we've got our accounting equation. Assets equal to liabilities and owner's equity. I may just write them as A, asset is equal to owner's equity plus liabilities. Now, what happens here? Our assets, you remember, that's where we said we find things like buildings, etc. Now, each time we buy an asset, let's say we buy land, it means the asset land has been created it's a plus because we didn't have it in the first place. So what will happen? All the asset accounts will be debited. In this case, I'll draw my T account here, and our land will be there. What do we do? Since this is a land account, what we'll do is, this is the debit side, right? We have, let's say it's 2 million. The land was bought for 2 million. We put it on the debit side. Now, we have said every account must have what? 2 accounts. It affects 2 accounts. Let's say this land we paid money. We did an EFT. Okay? So we'll need a second account. This money came from the bank. So definitely the second account will be our what? Our bank account. Now, since this account land is debited because it's increasing, it means where the money is coming from, it's coming from the credit. So the double entry system will require us to credit the account that is giving. So we'll go and credit our bank account with the 2 million. What does this mean? It means the bank account has given 2 million to land account. Now, in accounting, we can explain this. When we're recording, we say credit bank account, debit land account. So the account that is credited is the account that is giving. In this case, the bank account is giving out money, giving to land. So land account is given. So this happens each time the asset is increasing. So whenever we are buying an asset is increasing, then the asset account must be debited. Whenever we are paying out, or the asset account is going down, remember, bank is also an asset, just like it's cash. So here we have got 2 asset accounts. Bank account is an asset, land account is an asset. The other asset is giving, that is the bank account is giving, so it's going down, so we credit it. And the land account is increasing, we debit it. Now, let's have a look at liabilities. When we look at liabilities, when we debit a liability account, remember the liability accounts examples are capital account, it's a liability account. Accounts payables account is a liability account, right? Each time we increase a liability account, we increase it by a credit. Why is it so? Because each time somebody gives us money or supplies us goods on credit, the account increases. So let me have 2 T accounts here, right? On these 2 T accounts, let's say if we get money from, we go and buy stock or stationery from an organization, let's say it's Walton's. So we shall have to pay. So that one is called an accounts payable account, right? We can write in brackets the Walton's. We have been given by Walton's stationery worth how much? 20,000. So we have to credit them because they are giving. So the concept of double entry is simply credit the giver and debit the receiver. Now, we as a business were receiving, but we will not write our name on that account. We remember we've got our ledger book that has got a series of accounts. We will be having in that ledger account an account for stationery account. So asset stationery, it's an asset because we've not used the stationery. So the $20,000 is coming from accounts receivable from Walton's, and we have created in the process an account called stationery. So we'll debit the account that has been created, in this case, the stationery account, with the 20,000. So money has moved from the credit side, and it has been debited in the receiving asset account, because this stationery is our asset account. Now, owner's equity. Owner's equity is another account that is decreased by a debit and increased by a credit. Examples of owner's equity is a capital account. I will give an example of a capital account here, capital account. Right? I'll do my T, and I want to have another one called bank account. Yeah. What will happen is when the owners of the business give money into the business, they are giving capital, and they are represented by capital account. So in other words, the capital account is the owner of the business. So the owner is the one who is giving. And our principle of double entry says credit the giver and debit the receiver. Let's say 5 million has been given. If 5 million has been given by the owners, injected into the business, and it is transferred direct to the bank account. So we'll say capital is given what? 2 million. And this money has gone to the bank. Bank is receiving, so a receiving account should be debited. Remember, capital is owner's equity. We increase it by credit. So by crediting here, we have increased the equity account, the capital account. Bank account, it's an asset account. And it's increasing because we didn't have money in the bank. Now we have got money. So we have to debit the 2 million in the bank account. It's an asset, and we have said assets are increased by a debit. Now, I want us to look at a few transactions. What is happening here is we have got a business that was started. It's just an illustration. A business was started on 2 January 2017 with a capital of $500,000 cash, which was put into the business as capital. I want us to take note of two things here. First of all, we need to know which transactions or which accounts are affected. The two accounts affected are the capital account and the cash account. In the earlier example illustration, I used the bank account, but here we are not told that the money was deposited direct into the bank account, but we are told the money was given as cash to the business. So we'll create a cash account, which is an asset account, and a capital account. And remember, we said capital accounts, right, they are increased by a credit entry. Whereas asset accounts, in this case, cash is an asset account, it's increased by a debt entry. Now, we would like to see how we can represent that. 500,000 was injected into the business. It's a capital account. The capital account, which is giving 500,000, should be credited by the 500,000. That 500,000, it's going to the capital, to the cash account. Now, if I can redraw this, you see we have got our capital account there. Capital account. And we've got our cash account. Now, this line that we see, these lines, they are dividing the credit side and the debit side. The debit is this side and the credit this side for both debit, credit. Right, so we have said the principle of double entry says a transaction is recorded twice on either side of the trial of the account. Now, the capital account is giving, so it's credited. How much? 500,000 is illustrated there. And the cash account, it's an asset account which is increasing, so it must be debited. We debit the 500,000. One thing that I want us to be clear about is the first one was on the credit. It crossed the line, this dividing line that we talked about, this one, into the other side. So this double line that I've put here, it's dividing. It's like the equal sign on our accounting equation. So whatever we have recorded on this side, it must be recorded on the other side, and the amounts should be equal. So our accounting equation should never be offset or upset because we are recording on both sides of the account. Transaction 2, for illustration purposes. The firm gets a loan for 300,000 on January. My apologies for this small letter J. On January, and the money was deposited into the firm's bank account. Now, two accounts are affected, and these are the loan payable, right? Remember, a loan is a liability because it's something, a financial obligation that we have to honor at some point. So, what does that mean? That means the giving account, the loan payable account must be credited because it's a liability. We have said liabilities account are what? Are credited. And that loan will go into our bank account. Assuming we had nothing in the bank account, we have now something. So we have created bank account. an asset called bank in the sum of 300,000 has been created. Again, we have credited the what? The giving account, which is loan payable account, and the receiving account, bank account, which is the asset account, has been debited. Let's look at transaction 3. Suppose on 5 January 2017, Petrus buys a small shop for $200,000 and paid by check. A check has got direct effect. It will reduce our account balances in the bank account. And when that happens, it means the bank is giving. It's an asset that is giving. So the asset bank is decreasing. And when it's decreasing, what do? We reduce it. So if we have got the, if I put my bank account here, bank account, and the buildings account, because the shop is what we're referring to as the building here, buildings account, right? Now what will happen here is the bank, Petrus bought using a check, so money came from the bank. So the bank is the asset that is going down, because each time we make a payment, the asset, our money in the bank goes down. So our asset bank is decreasing. So a decrease in an asset is reflected by an entry on the credit side. It's giving. So our credit side is this side, and the debit is always this side. So our bank will have to be credited by the amount of 230,000, and the corresponding entry must cross this line to the asset that was created. So we'll come and record it, right, 230 this side. So the fact that we have recorded the amount of 230,000 on both sides, it means our account will balance, right? That's the double entry. Every transaction is good. So we'll go on and on and on. I will not go through all these, right? There's a transaction there that happened on 10 January, another one on 13 January, and the effect on our accounts is as shown. Now, I want us to quickly go to our sixth segment, discussion 6, the trial balance. Now, what is a trial balance? A trial balance, it's an attempt to cross-check the entries that we have made in the ledger account. The ones on the credit side should be equal to the balance, the total of the balances on the debt side. Why is that so? Because if it is true that we have done our double entry well, it means everything that is on the credit side is also having a corresponding entry on the left side, which is the debt side. So that being the case, it means what is on the credit side of our ledger book should also equal what is there. Like when you look at this example, if we were to add this, we'll get 230 here, and add this, it's also 230. So it balances. So that's the purpose of a trial balance, to cross-check. It's there for us to be able to check the mathematical accuracy of our double entry recordings. Now, I want us to have a look at the summary or the list that is shown on the slide. If you look at it, you will find that we have got the debit. I've indicated there the balances. We've got the debit balances and the credit balances. Let's assume the entries that we're doing, remember, we did not do all the entries. They were going on and on. At the end of the day, let's say end of the year, our accounting cycle ends in December, having started in January. So each time we are entering transaction, recording transactions, the funds, the balances are changing upwards, they're accumulating. Now, let's say at the end of the year, this is December 31st, we look at our accounts, and when we look at the total capital paid in by the owners of the business, it's amounted to 3 million. Retained profits, the profit that were not distributed and kept in the business, 5.655 million. And in the process, during the course of the year, we bought land, it's an asset. So it means its balances will be on the debit. So when you look at the two columns there, the column for debits, it represents assets. Those are assets, assets, assets. And those ones on the credit, it involves those things on the left side on the right side of our accounting equation. That is the capital and the liabilities. You see, if you look at the last line accounts payable, it's a liability. That's why it's on the credit. Because if we were to do our accounts, it will be on our credit side. Now, there is an error on my balance sheet there. On the debt side, I put 13,500,000. The other side, I put 15,755. Apologies for that. It should balance, right? It should balance the debit side and the credit side should always balance. Okay. Now, from the trial balance, what we'll do, we'll take what is in the trial balance and use it. Those balances are what we use to build or prepare our balance sheet at the end of the year. Look at the topic as at 31 December 2017, which simply means this was the state of affairs or the state of our financial position as at that particular date. A day earlier, perhaps on 30 December, it was not like that, but it's frozen as at 31st December 2017. Right. Our land taken from that trial balance, it would read those figures: 11.77 land, buildings, 230 vehicles, you name it. Now, when you look at our balance sheet, it's just taking the following form. We have got assets, right? We talked of the assets earlier on. We have got assets on this side. Then I'll divide it like that. Then we have got capital, where it's indicated financed by. We are referring to capital. And below that, you see liabilities. So if you look at our equation, right, we said assets are equal to capital plus liabilities. Now, so our accounting equation, it can be expanded and represented in the form of a balance sheet. So the balance sheet that you see on the slide, it's another form of our accounting equation. Now what is happening here is, we see here we've got our assets, right? When you look at these assets, the way we don't just write them at random. We write them in what we call the order of fixity, right? So the more you go up, they are more fixed and they are more rigid as you go up, right? And the value also tends, but not always the case, to be more as you go up. They are arranged in the order of fixity. So the assets can be divided into fixed assets, which we now call non-current assets. Then we've got the current assets below there. Current assets. Remember, they are still assets, so they are on the same side. The current assets, right? We have got fees, receivable, bank, cash, you name it. Now, whereas the non-current assets are listed in the order of fixity, the current assets are listed in the order of liquidity. Now, this liquidity, we say the more liquid, like cash is more liquid than cash at bank. Cash at the end is more liquid than cash at bank. Why? A kid asks now, I give there and there. The money at the bank, I will need perhaps to do e-walleting or to go and cash a check at the bank. Then we have got fees receivable, which is those people who still owe us. That one is a bit of a struggle, so it's less liquid because you need to send someone and perhaps phone the people and before you get the money. So it's in order of liquidity. This side, capital, we have said that's where we've got paid in capital that was injected by the owners of the business. Then the retained profits, the profits that were kept in the business instead of being distributed to them. Then liabilities. The liabilities can be further divided into two. Current liabilities, these are our financial obligations, the ones that we must pay within the next 12 months. Then we've got long-term liabilities. These may be loans, etc., which will have to be paid after 12 months from today. Now, this is a balance sheet and it is an expanded form of our accounting equation. When you look at the bottom there, the figures should balance. We've got 15.7 that side and 15.7 the other side. I did not critically check the figures, but I would like to believe they balance. Okay. Right. Now, I don't want us to look at that one. Let me go to that one. Now, I would like to explain something here. Now, we have got another important report that we shall look at. This is what we call the cash flow statement. Cash flow statement. Cash flow statements simply are a report that show the monies that came into the business and the monies that went out of the business. Now, what happens here is, why are cash flow statements an important record or a report in finance? The other statements are figures that can be what? Not representing cash. When we're doing the profit and loss account, usually we do it, remember the concept of the matching concept and the accrual concept. It means whether we paid or we did not pay, we still record it as an expense. Whether we received the cash or not, so long as we billed for it, we record it as an income. Now, cash flow, it is the real cash, the real money. So what do we mean? We say in order for us to know that we really have got money, we need to rely on the cash flow. That's why it's so important. I'll give an example. Let's say somebody goes to Dubai, buys clothes, and comes to Windhoek, sells the clothes. And this time around, the person goes to Dubai, buys goods worth 500,000, their clothes, comes back. When the person comes back, what does she do? She goes and sells the goods that she bought for 500,000. She sells them for 900,000. A profit of 400,000. But everything has been sold on credit. It means, yes, when we're preparing the profit and loss account, we'll say we obtain a gross profit of $400,000, but we don't have cash because the people we gave the clothes on credit, they have not yet paid back. So that is where the challenge becomes. That's where the statement of cash flow comes in. Now the statement of cash flow is structured into three. It has got cash from operations. Okay? Then it has got cash from, I say from or used in investing activities. Investing activities. Right? Then it has got the third segment, which is cash from or used in financing activities. Right. Those are the three components of the cash flow statements. Now, when you look at the first part, cash from or used in operation activities, the operations are the core business. That is the reason for the formation of the business. If we sell revenue, money that comes in, we put, it's what? Revenue. Cash that we receive, revenue. It's a what? It's a plus. It's coming into the business. But in the process of doing that, we've got expenses that we incur. Suppose we buy raw materials, right? Purchases, right? Purchases that we make. They involve cash going out because we have to pay our suppliers, right? At the end of the day, we have to net these two, right? Hopefully, if our revenue was more than the purchase and the other expenses, we will end up with a what? A positive amount here. Hypothetically, let me just take a figure from the blue and say our net cash from operations here, it's what? 2 million. Okay. Now, we'll go to the next stage. Cash from or cash used in investing activities. What are investments? Remember, we bought land. Land is an investment, isn't it? So, it's not part of our day-to-day operations. It's an investment. So, land. Since we bought land to the tune of 11.77 million as shown on the slide, it means that money went out. So it's a negative. We'll put it in what? In negative. Buildings, all those assets, we bought them. If we paid for them, then they have negative. Buildings, right? We have negative. Furniture, negative. Equipment, negative. So we have a net negative. In this case, if you look there, it will be 13.5 million, assuming we paid for everything. So that money went into investment activities. Okay. Now, the last segment now, cash from or cash used in financing activities. Now, we are saying during the course of the accounting cycle, the owners of the business paid in money, injected money into the business. So this money came into the what? Business, to finance the business. So, paid in capital. Right? It's a what? Positive or negative? it's a plus because it's coming into the business. Retained profits. Retained profits, what are they? It's money that came into the business. So it's a plus to the business, it's a plus. Okay? Now, let us say we borrowed money. If we borrowed money, it's money that was borrowed to finance the business. The loan, it's also financing the business. It's money that came in, so it's a plus. But sometimes we start paying. We paid. If we are paying the loan for the loan repayment, that is money going out. So loan repayment becomes a negative. So the totality, we'll put it there. Let's say, having looked at that, financing activities, it's a plus. So it may be plus 4 million. I'm just thumb-sucking these figures, plus $4 million. Now, when we add these figures, if we add this amount, we have said it's 2 million, and this amount, this one is positive, and this one it's negative, and this one it's positive. If we add them, the net is what represents the cash the business generated during the accounting cycle. So, ladies and gentlemen, for now, we end it there. I hope you have managed to get one or two things. And in our concluding remarks, let us say, remember that accounting revolves on the accounting equation. Owners' equity plus liabilities. And we have said these ones will go to in our balance sheet, they will go to the left side of the balance sheet as assets. Okay? And here we can decide to call them fixed assets, that is, we split them further, and current assets here. Okay? Then whatever we write, land and buildings, etc., we put them there at their value, then we net them there. Current assets, we also write them there, the accounts, receivables, cash at bank, cash at hand, we put them there. Then from this side, the right side, it's now representing this part. It also comes to this. When it comes here, what do? We say, okay, here we have got financed by. That's financed by, that's owner's equity. Right? Owner's equity, which is made up of what? Of paid in capital, and retained capital. And we record them as well. And when we balance them, we put the total figures there. Then we come to liabilities, right? We begin with current liabilities, those that should be honored within the next 12 months. We put them there, right? We have got accounts payables, we put them there. Here we have put these ones there, these ones there, and we put them there, we net them there. Then we've got long-term liabilities, LT liabilities. We also put them there, we add everything there. So when we add this side, it's equals to the right side of our accounting equation. It must balance with this other side. So the figures here and the total of the figures from this side should always balance. That is why we call it a balance sheet. It's a sheet of paper that has got balancing figures at the bottom. And it's also an accounting equation saying all these things that you find on the right side were financed or acquired using resources that were injected by the owners or supplied by outsiders, third parties on credit. Thank you very much, ladies and gentlemen. I think our presentation will end here. Until next time. Thank you.